This week brings the latest ECB interest rate decision on Thursday, coming at a time where, of course, everyone's focusing on the Federal Reserve. Many expect a rate cut next week, but potentially a 50 basis point cut. But the ECB were moving in the opposite direction. They paused last time around, and markets are expecting the same this time. So is this the end of the easing cycle for the Eurozone? And what does this mean going forward for the likes of Eurodollar and the DAX? So let's jump into it. First and foremost, this is the outlook according to Refinitiv in terms of market pricing for the ECB going forward. As you can see here, 99.3% chance attached to a pause. Next time around, 91%. Next time around, 72%. So it does fade a little bit, right? But ultimately, the fact of the matter is, as we move further into the future, so there's greater uncertainty. And if I was to say where a rate's going to be in a year from now compared to where will rates be in a month, I'm obviously going to be a lot more confident with my view in a month's time. And that's why there will always be some sort of pricing around a potential change in the future. But as you can see here, by sort of midpoint in 2026, markets still think there's only a 50% chance that we're anywhere but here. So that means that by and large, markets are expecting to see the ECB essentially draw an end to their easing cycle. Now, let's look at a few charts to see whether that's justified, whether we're going to see them likely shift that narrative or not. And bearing in mind, when we're looking at some of these data points we're talking about, we're also going to see economic projections from the ECB this time around. So any adjustments in terms of their outlook for these indicators, whether it's inflation or unemployment, things like that, that also tells a story around the narrative for rates at the ECB going forward. Now, rates as a whole for sort of the wider spectrum across the globe have been moving lower, but some countries and central banks have been doing it at a much faster pace than others. The ECB, as we can see on this chart, are on the lower end of that spectrum. They have the sort of orangey line in the middle, and they're sort of in that zone that I would expect many of these central banks to be drawing as their sort of terminal rate zone, so the area where they stop easing. The ECB is already essentially there. Worth bearing in mind, they started off at a much lower rate. If you look at the left-hand side of this chart, you can see they were in negative territory. Other central banks weren't. They also were slow to get going, but once they did, they just raised rates time and time and time again. Now they're cutting rates time and time again, but last time they paused, this time they're going to pause, next time they're likely to pause. And so it appears to be the case that the ECB are essentially the first of the major central banks to stop or halt that process. You can see that the SNB at the bottom end did lead the way. But I think by and large, the likes of the ECB and potentially the Bank of Canada, but I think they've probably still got a little bit more in the tank, they've already done a lot of the heavy lifting. And so that has sort of relative yields, relative rates, comparatives to come into play when you're looking at them compared to some of them at the top end of this list, the likes of the Bank of England, the likes of the Federal Reserve. If they've still got a lot of easing to do and the ECB don't, then we could see a shifting in terms of the narrative. This is the outlook in terms of inflation. We can see essentially we've got core inflation at 2.05, core inflation at 2.27, headline inflation 2.05, and essentially the trajectory we've been going on recently is on path to maintain 2%. We can see that the left-hand side of the middle section shows that there are going to be months that from a base effect standpoint do provide upside in terms of inflation. We're likely going to see disinflation kicking in at the beginning of next year as well. But by and large, if you look at the trajectory over the past 4 months, it's been very little inflation essentially. And so that really points towards inflation being largely under control, according to the recent trajectory. The 3-month annualized across both core and headline, both essentially at 2%. So inflation has been combated. In terms of the PMIs, what's notable here is that the composite reading up at 51. Crucially, it's the manufacturing sector that's really recovered in a meaningful manner. You can see at 50.7. The services reading has been sort of there or thereabouts in terms of expansion territory for some time now. But the manufacturing sector, as we can see here, has seen a massive boom of late. Much of this will come in line with the sentiment around a growing expansion in terms of spending on defense and within the Eurozone, which some of the best performing stocks in Europe have been in the defense sector, the likes of Rheinmetall and the like. And so you can see manufacturing within the Eurozone has done incredibly well to get back into expansion territory, considering where it was a couple years ago. So things looking a little bit better on that front. In terms of the unemployment perspective, you can see unemployment on the rise across many of these major nations. Not necessarily the case with the Eurozone. The Eurozone has already started high, but it's been gradually drifting lower. So we're not necessarily seeing an uptick in terms of unemployment that the ECB needs to combat. We're not necessarily seeing contraction within either of the PMI numbers now. We've seen inflation by and large under control, and all of this really points towards an environment where the ECB is likely to want to keep some of its powder dry, essentially, with a view to acting if need be down the line, right? So that essentially signals we could start moving in a direction where people are looking at other central banks, not necessarily at the ECB per se. Now, I was talking previously about some of these sort of comparatives that you can get where you're looking at relative rates and the like. So I thought an interesting one would be the likes of the euro against the US dollar. Euro dollar, of course, is pitting one central bank that's essentially already finished its easing against a central bank that's really about to get going in a meaningful manner. Now, we can see here in terms of price action over the past month, essentially through August and the beginning of September, we've been essentially range bound for this market. Anyone that follows the dollar index will note this looks very similar, but it's because that's heavily weighted towards the euro. So we've seen a bullish breakout now, just pulled back over the near term, but now starting to turn upwards once again. So we've seen the breakout from a range. Let's go out into the daily time frame. We can see here we do have this rally, higher low, rally. This is essentially a consolidation sit within a bullish phase here. And so that to me points towards this current pullback being a likely retracement unless we break the 117 level. We haven't done that. Instead, we've come into this deep retracement zone. Let's just get the 61.8 on there as well. So we've come into a deep retracement and now starting to turn upwards. So this is the interesting area for me. And you've also got that resistance area. So what was resistance turned into support, accompanied with this zone of the Fibonacci levels. That to me looks like a really interesting area for the bulls to come back into play. It's how it's playing out at the moment. I don't necessarily know that that's how it will do. It could still come into a deeper retracement. But that zone as a whole, because you have a number of different levels there, right? That's just one of the three drawn there. So we've got this sort of zone here that I would expect to see the bulls coming back into play. And that's how it looks like it's playing out at the moment. Essentially, we could still roll over again, but as long as we remain above the 117 level, for me, this breakout is likely to extend. And if we were to see strong forecasts in terms of the economy or growth or lower unemployment or inflation to remain under control, all those things feed into the narrative, and particularly look out for commentary from Christine Lagarde around the potential end to easing and whether rates are going to stay here for some time. If they do, then you start to see the comparatives coming into play, and essentially the more dovish things look on the US side and the Federal Reserve side, the more we would expect to see upside coming into play here for this currency pair. I just want to bring it out into the wider time frame and show you we are set within this wider downtrend. That's certainly worth bearing in mind. Just trying to see if there's any particular trend lines up ahead. So you've got the possibility of that from a fib perspective. Let's see where all the fib resistance levels are. So we have moved through fib. You know, ultimately, I think there's still further to run. And I think there's a good chance we do break out of this long-term trend. But obviously worth watching out for these key levels. Towards the upside, you've got that prospective trendline resistance. We've broken through Fibonacci resistance. So that points towards the possibility of further upside to come. Then we're looking here at the DAX. Now, the DAX has been sort of what looks like rolling over here. Let's just get rid of that. So the daily time frame, we can see we saw an almighty run up from the lows in April. And then we've been sort of not looking great, quite frankly, you know, sort of gradually trying to make highs, but not really managing to make new highs here more recently. So that looks like a potential head and shoulders formation. Don't necessarily know if that's going to come into fruition or not. A break below 23375 would certainly make things look a bit better on that front. Certainly there's question marks at the moment around sort of stability of debt levels within Europe. There's question marks around the French side of things, but of course this is the German side, so we're not necessarily factoring in the French sort of political instability and uncertainty too much here at the moment. We've of course got the fact that we have this trade deal with the US, but there's still question marks around the car automotive sector for Germany and quite how businesses are going to function and do under this new environment where essentially have to pay for access to the US market. But yeah, for the near term, we can see here we've got this bearish trend playing out. This is your near-term swing high. We sort of rallied into it and now faltering once again. There is a good chance that we still hold up once again, start to turn higher. So as long as we remain above this 23375, then the bullish trend does still remain in play. But no doubt, that is very different to what's happening here. So if we do break the 23375, it starts to look a little bit more bearish here for the DAX. And certainly this interest rate decision will play a part of that. But I wouldn't necessarily say that it's just the case that rate cuts mean we should be bullish for equity markets and the pause is bad for equity markets. That's not necessarily the case. And this is the Euro 2-year, which essentially reflects near-term rate expectations. And as you can see here, we saw that period where we've seen that significant period of easing. And then since then, we've sort of seen things drifting upwards as equity markets move upwards. That essentially means that if people are feeling positive about the Eurozone, you would think that they're also positive around equities as well. So ultimately, if we did see additional rate cuts, that probably comes because there's question marks around the economy, and that's probably bad for the DAX anyway. So wouldn't necessarily hang my hat on the idea that like equity markets are going to perform poorly if we don't hear that there's going to be additional rate cuts, because actually we've got to the point where they're quite comfortable with things. They feel confident around the economy and inflation and everything like that. And it could take a bit of a shock for them to act once again. And that shock wouldn't be good for equity markets. So on this occasion, I don't necessarily think high rates are good for equity markets, but it's not to say that lower rates are needed for equities to continue to rise. And like I said, we've come back in towards this key support level. We have sort of tried to rally up very closely to that swing high, at the moment faltering, but it's a question mark. Do we break the 238.92 level, or do we break the 23375 level? Whichever one breaks is going to tell us a lot about where we go over the near term. I hope that's been useful. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Make sure to like and subscribe for more content like this. Thank you.